Well, good afternoon. Thank you for joining us for our Navigating the Home Buying Process webinar with an emphasis on how to obtain a home loan. I'm Corby Gage, the Executive Director of Coastal Housing Partnership. And with us today is also Kim Pascage, Program Manager for Coastal Housing Partnership. Today's webinar features two local loan officers, Susan Bonanno with Loan Depot and Kathy Gray with Guild Mortgage. Kathy and Susan are both part of Coastal Housing Partnership's network, and as part of this network, these lenders reduce their closing costs for their clients who are employed by companies that are part of Coastal Housing Partnership. The format for today's webinar is I'm going to be asking Susan and Kathy questions about the process of obtaining a home loan and getting ready to purchase a home. The remainder of our time together will be for you to get your questions answered. We'll be recording today's webinar, so we can send you the link to the recording after the webinar. The webinar format means that your cameras are off and your microphones are off. So if you do have questions, and we hope you do, please put them in the Q&A, and you can ask your questions anonymously if you like. And feel free to put your questions in the Q&A at any time during the panel. And we'll have Susan and Kathy answer these questions after the initial questions that I'll be asking them. Since the first step in the home buying process is to meet with a lender to find out how much of a loan you can afford, the information you're going to receive today is going to make you much better prepared to take that important first step of home ownership. Before we hear from our panelists, I want to remind you that one of the benefits you have, since your employer is a member of Coastal Housing Partnership, is a closing cost benefit. We've partnered with local real estate professionals that include real estate agents, lenders, home inspection firms, a couple of residential developers, a moving company, all offer savings on the cost of their services, and this can significantly reduce your closing costs, generally by 50% or more. So it's a good idea to be able to take advantage of those. You can find the list of our network partners on our website, coastalhousing.org. And as I mentioned, Kathy and Susan are part of this network. So let's get started. Susan, would you share a little bit about yourself?
Well, I have been living in Santa Barbara since 1990, a long time, and lending for the last 16 years. And I love helping people learn about financing.
Great. Thanks, Susan. Kathy, would you share a little bit about yourself?
Sure. I've been with my current company for almost 15 years, and but I've been in the mortgage business in some way, shape, or form for most of my adult life. And I speak Spanish, so I help English and Spanish-speaking families obtain wealth through home ownership throughout California, but I am in Oxnard.
Great. Well, we're delighted to have Kathy and Susan with us today to share their expertise. I appreciate your time today. So let's get started. Kathy, how does someone know when the right time to meet with a lender is? If someone's a potential home buyer, how do they know when to meet a lender? Do they need to be ready to buy, or is it a good idea to meet with a lender just to even develop a game plan?
Absolutely. It's always a good time to meet with a lender as soon as you think you're interested in buying a home, even if you can't afford one right now. Preferably before you go out looking at homes, before you speak to a realtor, because a realtor is going to need to know what you're pre-approved for. There's no need for a realtor to show you an $800,000 home if you only qualify for a $600,000 home. And then, of course, you do want to get educated in what you qualify for and all the rest of the home buying education. Rates, fees, closing cost, down payment, all of the above. And if you're not ready now, you have that education so that you'll be ready when the time is right for you.
So do you find, Kathy, that sometimes people are ready to buy before they think they are, and just by meeting with a lender, they're going to find out the steps of the process and find out that they may be ready to buy sooner than they thought?
Yeah, sometimes buyers are ready because buyers don't always know, especially the first time home buyers. They don't know what programs are out there. So once they sit with a lender and we get them educated with all the different programs available, whether it's with your own down payment money or whether you need down payment assistance programs, this is where you start with getting the education so that you can determine whether it's the right time to buy now or you want to wait, 6 months, a year from now.
Great. So when you're going to a lender, you're going to ask for a pre-approval. What is a pre-approval and why is it so important?
Well, I like to explain that there's really three stages. There's a pre-qual, there's a pre-approval, and there's an underwriting approval. The pre-qual is basically when you're just talking to a lender, either by phone or in person, and you're just going over, okay, this, I make this amount of money a month, I have this many bills, and my credit is in the high, 700 numbers. They're not actually running your credit report yet, or you may be going on to a lender's website online where you're, it's a self-help calculation where you enter how much money you think you make, what your debt is, and what you can afford. That's pretty much a pre-qual. A pre-approval is when a lender, a human, actually goes through your credit, your bank statements, your credit report, even if it's a soft pull. Most lenders now can run a soft pull on a conventional product. And Susan's going to touch more on that later. But this way you don't hurt your score. And then also, that your capacity and your budget and all that. And we give you an estimate. A lender should be able to give you more than one estimate if you are considering maybe a conventional loan, an FHA loan, a VA loan, down payment assistance, whatever it is. A good lender will give you all this information up front. The more education you have up front, the better decision you can also make and the more comfortable you will be to write an offer. The underwriting approval stage, that can also be done up front after the pre-approval. If a lender is able to send all your documents to an underwriter, this will confirm what you're approved for and your buying power. This will also strengthen your offer because sellers like to know that you're not just pre-approved by a loan officer or lender, but that you're also underwriter approved. It does have more strength to your offer. And also it'll make the process smoother because the lender has already done all the upfront work. And you will be also more comfortable because you're not going to be rushing to get documents that an underwriter is requesting while you're trying to write an offer. So there are benefits to the pre-approval and the underwriter approval stages.
Great. So when someone gives you the pre-approval, a lender gives you a pre-approval, that's the amount of your monthly payment that includes the mortgage payment, real estate taxes, insurance. Is that everything?
Well,
that would be
it's
the
an
full monthly
estimate.
payment?
It's an estimate because interest rates change daily, sometimes twice a day. So the pre-approval, it also could vary between a home without an HOA, or if it's a condo with an HOA, or let's say you have a property with Melrose. So all these amounts are going to be different depending on what your budget and what your choice of property is. So for example, you may qualify for a $500,000 home, but you may, if it has a high HOA, that may only buy you maybe a $450,000 condo. So all this is why the pre-approval and meeting with the lender is so important. And knowing this information up front.
Right, and really knowing your price range of what to be looking at with the real estate
Exactly.
agent. Great. Thank you, Kathy. Susan, let's talk a little bit about credit scores. That's always a topic that people are so interested in. And of course, everyone's trying to improve their score and have the best score to be most competitive. But there seems like there's a lot of misinformation about credit scores. And so, first of all, why is the credit score so important when obtaining a mortgage loan?
That's a great question. When we're pre-approving you, we're looking at three things basically. We're looking at your savings, we're looking at your income, and then the third piece is your credit. So your credit score is important both for qualifying for a loan as well as how we price it. So it affects both. For credit scores, every type of loan program has a different minimum score, whether it's FHA, VA, Jumbo, they're all going to be different. But generally, the higher your score, the more options you have. Doesn't mean you don't have options if your score is lower, but it's helpful for having more possibilities for loan types. And then also when we price a loan, we also are looking at what your scores are, and pricing is basically has to do with choosing the rate. So lenders are willing to give you in general a lower rate if your score is higher, because pricing for loans is what they call risk-based. So the higher the score, the less risky the lender is going to look at it. The great thing about scores, though, is they're not static. So your score might be 680 now, or 620 now, or 580 now, but it doesn't mean that it can't be, 20 or 50 points higher in a relatively short amount of time, 3 months, 6 months. There are things that we can do to change the score. People have basically 3 different credit scores. We have 3 different credit reporting agencies. And as Kathy mentioned, when we pre-approve you, we normally start with what they call a soft pull, just pulling one of your scores. And it does not hurt your credit history. It doesn't affect any of your scores. That's a big fear a lot of people have. If I'm going to have my credit pulled, is that going to bring my credit down? And so doing the soft pull is a really safe way to get a picture of where your credit is. And sometimes when we take that picture, we find out something that the person doesn't know. Maybe a credit card company or a library even reported a late payment to something, and it's now impacting their score. That gives us some time in that pre-approval process to fix that situation, to repair it. There are a lot of things that we can do to change someone's score, but usually those things are not something that you could guess. And so it's really important to have an expert look at that, and that not even one of us lenders. It might actually be a credit reporting agency or a credit repair expert. There's a lot of things we can do in the office by looking at the report, going over it. We can do what if scenarios. We can call the credit reporting agency, but a lot of times what we can do is not something you would guess. We see a lot of things with medical. A lot of us have medical insurance, and sometimes it doesn't cover something. People don't even know that something has been reported, but because of the HIPAA privacy laws, that's often very correctable. So there's a lot of things we can do, and really the bottom line is if your score is lower than you think it should be. Don't let that stop you, because there are things that we can do to help you improve that, but also don't try to guess what those are on your own. It's, people will often come in and say, well, I just, I knew my credit was an issue. So for example, I just paid off my credit cards and closed them. Closing your credit cards is not a real good idea, because we're looking at the number of credit lines that you have open. So talk to someone before you try to change it on your own.
You raise a really good point, Susan. It seemed, I hear so frequently people saying, well, I know I want to improve my score, and I don't want the lender to see my score now. So I'm going to wait, try to get my score better, and then go see the lender. And so frequently I hear what they are doing to change their score is probably sending it the other way instead of improving it. So, that sounds like another good reason to meet with a lender early on in the process, so you have time to get that score improved.
People are often surprised, that their score is, they can still buy a home in spite of whatever their score might be. So it's often good news, and there's often one thing that's funny about credit scores is with couples, they tend to compete over who has the highest score. So it's always fun to see.
That is fun. Now, what is the situation when you have two people buying a home? Which credit score do you use, or is it a combination? How does that work?
That's a great question as well. Like I said, we all have 3 credit scores in general. Unless you have a very short credit history, you generally will have 3 scores. And most lenders take the mid score per person, and then we use the lowest mid score when we make our pricing decisions. Now there are programs for everyone. So there are some special programs. I had somebody last year whose score dropped, and he didn't realize it until he got into escrow. We did find them a special lender that allowed us to average the 2 scores and therefore qualify. So no matter what your issue is, there's likely a fix for it. And it's just finding the right program for you.
Great. So, but let your lender suggest. It's what you all do every day, is look at credit reports, credit scores, and you're going to see the thing that's probably hurting someone and help them identify that. So it seems like that's a really good strategy, is to talk to the lender.
Yeah, there are some basic things like having all of your accounts at below 50% of their maximum credit line, obviously paying your payments on time. Those kinds of things that we can look at right away. Paying off debt is one of the fastest ways to improve scores, but it's not always the smartest, because maybe your debt to income ratio is fine with the payments that you have, but you need more cash to make your down payment. So there's so many moving parts. It's really good to look at the whole picture before we make a decision as to what would be helping you the best in your situation.
Right. And the lender's looking at that big picture. So that's really important to identify that. So it seems like the 2 obstacles that I hear most frequently in terms of pre-approval and getting to that step of meeting with the lender are, oh, I don't want to have my credit run. It'll impact me. Sounds like you just negated that. There's a soft pull, so it's not going to impact your credit. And Kathy, there's no charge for pre-approval. So why wouldn't someone take the step of meeting with a lender? It just seems like they're going to have so much more information and be so much more prepared to make that decision. So that's great. Most of the people that we work with are first-time home buyers, although you don't have to be a first-time home buyer to take advantage of the Coastal Housing Partnership savings. But I know a lot of people, Kathy, are interested in first-time home buyer programs and what's available. And so who's considered a first-time home buyer, and are there first-time homebuyer programs available that are more beneficial than if you're not.
Yes, first-time home buyers, a first-time home buyer is technically someone that has not owned a property in the last 3 years. So let's say you owned a property 10 years ago. Well, it's past 3 years, so now you're a first-time home buyer again. Some agencies or some programs do, however, not necessarily want you to not own a property in the last 3 years, but they also don't want you to be on title for 3 years. So it just depends on the loan program, and that will determine whether you're classified as a first-time home buyer, but you're pretty safe if you've never been on a property, title, or you've never been on a loan with someone for 3 years. Now, if by chance you co-signed for somebody, but you never lived on the property, you don't claim the interest on your taxes, that can be documented so that the underwriter clearly understands that you were just a co-signer for somebody, 2 years ago, and you've never lived in the property and you don't make the payments. So we will require proof that, somebody else is making the payments for the last 12 months at least.
So pretty broad definition on that first-time home buyer. Are these programs income restricted, or is any first-time home buyer eligible for these?
The first-time homebuyer programs vary. Yes, some of them are income restricted. A lot of first-time home buyers, if you're military, there's the VA that's 0 down. The FHA only needs 3.5%. And then for the conventional side, there's Fannie Mae and Freddie Mac that have special programs for first-time home buyers. And then this typically equals to maybe a little bit lower rate, lower mortgage insurance, down payment as low as 3%. And they might even give you some incentives as well with those programs. Then there's programs where you're actually asking for assistance, such as CalHFA, GSFA, and whatever other agency. Sometimes even your employer. I know some employers that are part of coastal housing can help you with down payment. So depending on what type of down payment assistance program you're using, yes, and they each have their own guidelines and they each have their own income limits. So this is why, again, it's so important to meet with a lender and understand what program and what kind of assistance you're getting. Sometimes some of these down payment assistance programs do carry a lot, and I'm talking about the down payment and the closing cost assistance programs. Sometimes they do carry a little bit higher rate or a little bit more on the closing cost, but if you don't have any money for these things and this is the only way to get you into a home, then that should be fine.
Okay, so the lenders is going to be able to share with you the different options.
Yes.
And show you the choices that you have.
Yeah.
So someone doesn't have to go out and try to do the research on their own. Just get with the lender and say, what programs am I eligible for?
Yeah,
Right.
some programs are also by family size, and some are just, they by county. So there's a lot of different numbers to stay on touch on, and they are updated from time to time, typically once a year. So it's very important.
Okay. Well, Susan, Kathy just kind of teased us a little bit with this 3% down and 0% down. I know a lot of people think that they need a 20% down payment to get into a home. Is that true? Do you need 20%, or are there other low down payment options? Can you walk us through that a little bit?
Sure, yes. As Kathy mentioned, there's a lot of different types of loan programs. It's not just FHA or VA. Conforming also has programs. So does Jumbo. And, in Santa Barbara County, if you're going to buy a home, usually you need a Jumbo loan. And so, they also have programs for, lower down payment as well. Now, when I say jumbo, the audience may not know the different loan categories. So there are conforming loans basically go up to 766, 550. Then we have something called high balance loans, which in Santa Barbara County are actually a lower limit, 838, than it is in Ventura. Kathy, what is it in Ventura right now?
The conforming is still the same, 766, 550. But I believe for Ventura, for our jumbo is, the next one is 954, 500.
Okay, so you can go almost, over 100,000 higher with a conforming loan in Ventura County. By county is how Fannie Mae and Freddie Mac decide the county limits. So in Santa Barbara, a lot of my first-time home buyers are actually using a jumbo loan to purchase their home. So we also need programs that either give you a less down payment or a higher debt to income ratio to make it easier to qualify for a new home. And there's different ways you can do it. Some have, as Kathy mentioned, a little higher rate. Some have something called mortgage insurance to let you buy with less down, and some do a first and second loan program. So there are different ways to structure it if you don't have the entire 20% down, which is kind of considered the standard for not having mortgage insurance. But there are definitely other programs. And what I'm seeing in Santa Barbara County is, I would say 90, maybe higher, 90% of my first-time home buyers are getting some kind of gift funds from a family member. Somebody helping them to put that down payment down. And if you don't have that, as Kathy mentioned, there are down payment assistance programs and employer programs. Cottage Hospital has a great program like that. The other thing I see a lot of for down payment is that the funds can come from your retirement. So you don't have to necessarily liquidate your retirement. You just borrow from your retirement to supplement your down payment. That's another way that a lot of first-time borrowers are getting to whatever, 10%, 15, 20% down. But yeah, 20% is not required. It really does depend on the loan size, how much, because each loan has a different minimum.
So someone should definitely go see a lender rather than waiting till they've saved 20% or even 15 or 10%. I mean, there could be loan options that show that they're ready to buy right now.
Yeah, I've had a lot of people buy and have told me, had they waited to have 20% down, they could not have saved at the pace that houses were appreciating. And they would always be a little bit short. But now that their house is appreciated, they have plenty of equity in it. So it's definitely not something that should stop you. It's just a question of finding, what you can afford. And if you are a little bit short of that, whatever the necessary down is, then we can always have a plan for how to get there and how long it's going to take you. And at least you have a path to follow to get you where you want to be.
Mm-hmm. Having that game plan makes so much sense too, because then you see that end goal and okay, I can do this if I accomplish this, if I save a little bit more, or work on the credit. Just that's just makes it so much more real than just kind of having this esoteric goal out there that you don't know when that's going to happen. So meeting with the lender, you're going to be able to really nail down all of those requirements. So that's great. Thank you.
And it's funny too, even with the down payment, sometimes people make mistakes. Like I've had people saving money in, a safe in their house, or, they're keeping all their money in a foreign country, and that makes it more difficult as well. When you go into escrow, if all your money is in another country and you have to transfer it, or if it's in, underneath your mattress, and we can't, prove to the bank that it really is your money because of different, banking rules about cash. So again, it's not something like most people think cash is king. Like if I have cash, that's perfect, but you can't just use cash to make your down payment. So it really is good to plan in advance.
Yes,
Another good reason to go see a lender.
yes,
Yeah.
and may I add, don't get a personal loan for your down payment either.
Yeah, these are all the things the lender is going to help you do. I mean, in terms of you're thinking back on the credit score, not making big purchases right before you're about to close on your home. And I mean, so many of these things we don't really realize the impact of. So that's where your lender becomes your best friend through this whole process in terms of really guiding you and advising you.
Mhm.
Kathy, so I get asked the question all the time, well, how do I pick a lender? Who do I choose? What do I look for in a lender? What's that process look like?
Well, speaking of best friends, you should speak to a lender that you're comfortable with, like a friend, because you're going to be in communication with this lender throughout the process, whether that takes you 30 days or that takes you 6 months. Your lender is your confidant. You should be able to speak to a lender that you're comfortable communicating, because if there's something you don't want to tell us that you don't think we're going to find out, we will. So not only the comfortability ability to speaking or connecting with a lender, but also a lender that is licensed, first and foremost, that has been in the business a while, that is willing to explain all the products with you, the rates, the closing cost. All that is important. You can speak to more than one lender, and hopefully all the lenders can give you an estimate, because an estimate is going to be the only way for you to compare. And even though it's hard to compare rates and closing costs sometimes, if you don't do it within that day, or sometimes even within that morning or that afternoon, because as I mentioned, rates change all the time. So a lender is your friend. Bottom line.
Okay, so when you say choosing your friend, this isn't necessarily needing to have a friend who already is a lender, but that once you pick your lender, they are going to become your friend.
Correct.
Okay.
Yeah, no, I didn't mean, like your neighbor, or, they can help you. They can tell you their experience, but a knowledgeable licensed lender or loan officer is the correct person to connect with for all your education, because they're going to tailor that loan estimate based on your information, not your friend, not your neighbor. It's, it's for you. It's a personal thing.
And you touch on education. I think that's so important, is that your lender is really, guiding you through the process, educating you on the process. You don't want to feel rushed or hurried in the process. You need to know that, you need to have the confidence that you understand the process, that the lender is really on your side and is not trying to push you into anything. So I feel, if you have that sense of being pressured, that you might be in the wrong place, that you really are wanting someone, to be holding your hand and to make sure that you are comfortable with the process, and that it's a big step, and that they are guiding you along.
Yes, it's very important, because, and that's especially true in the difference between talking to a local human that you can, either get on the phone when you need them, versus an online lender that you don't know who you're talking to. you can't get a hold of them. And that is also very important. And realtors also like to, know that it's a local lender that has the reputation or has the experience to guide you through all the way from pre-approval to keys it on in your hand.
Mhm. You bring up a good point about e-lenders. That can be a really challenging relationship. It may seem sometimes like they have better interest rates, but not necessarily, and not necessarily better service. So being able to, I mean, you're going to probably do most of your transaction, um, you know, via computer or phone. But if you need to walk into someone's office and talk to them or their manager, it's important to be able to do that. To be able to
Yes.
get your loan closed. And I think real estate agents like to know that you're working with a local lender as well. They feel that confidence. So getting your offer accepted might be that might be helpful, knowing that you have a local lender.
Yes, absolutely.
Right. Susan, the lending market has changed. And we're seeing, higher interest rates. We're seeing less inventory. Sometimes it can feel kind of complicated to be buying right now. One is this a good time to buy? And, are there strategies to help mitigate some of these higher interest rates that we're seeing?
Well, definitely there are some strategies. The interest rates are higher than they were during like COVID 2021. But they're still historically pretty reasonable. Um, so if the current rates, which are, just under 7, in general, if the payments are too high, there are a number of strategies you can do. What they call a buy down, where the rate's going to be 1 or 2 points lower for the first 1 or 2 years or 3 years. You can pay what they call points, which is spending some money now to reduce the interest rate for the life of the loan. That makes it easier to qualify as well because your rate is lower. Sometimes people buy with a adjustable rate mortgage, which is instead of the rate being fixed for 30 years, it's fixed for a shorter period of time. In some cases, those rates are lower. Not always in this market, but it can be. So there are some strategies in terms of dealing with the payments. I've had people also go with 40-year terms to get a lower payment. So there are definitely strategies in terms of making sure that you're comfortable with the rate and the payment. I think the main reason that it's challenging right now is because it's a very fast-paced market. It is not as challenging as it was during COVID when there were, 15 offers on every property that was on the market. So I'm still seeing some multiple offers, but I'm seeing less than when interest rates were super low and there was more competition. I think the main thing that's important is that it is a fast moving market. So people have told me, wow, I saw something and it was like in escrow 2 days later or 1 day later. And so it's just another reason to be prepared in advance because if you've already figured out your budget, you know where you're comfortable, you know the highest offer you can make, it's going to be easy for you to act quickly and to dive right in. Where if you haven't really thought about that, when you find something that you love, you're not going to be able to act so quickly because you're not really fully prepared. Pre-approval can be done very quickly. I mean, technology has really changed the pre-approval process. There's many times we can verify your income online. We can verify your assets online. We can do a quick soft pull. I mean, it could be done in under an hour and you could be pre-approved. So technology is there to assist you and get you to get where you need to in order to make your offer quickly. but, I'm seeing a lot of short escrows, and if you're competing with a cash offer, those are often shorter escrows. So I have people in escrow right now that are like 17 days, 15 days. It's just a way to compete against other offers. And so being prepared and just having all that paperwork done really does help move you along. I would say that the speed is probably the number one way that I've seen things change. Everything is kind of quick.
So from a lending standpoint, if you have gone in, you've gotten your pre-approval, you've gotten all your documents in with the lender, the lender can get you closed in that short 15, 17 days. That's doable.
Absolutely. I mean, for a while when during COVID, when it was really, really busy, it was hard to get appraisals done that quickly. But right now it's not as busy and you can still get an appraisal because you can be, as Kathy was mentioning, you can have yourself completely approved by an underwriter. But once you go into escrow, you're still going to then need to get an appraisal because we also look, as a lender, we look at not just you, but the house. And if it's a condo or a townhome or a PUD, then we also look at the homeowners association. So we're going to be looking, the underwriter is going to then add your property and your association to your file and just make sure everything works. In some ways, it can be very reassuring as a first-time borrower to know that, hey, you know, someone's looking at the property, someone's looking at the homeowners association, where everyone is looking to make sure that all the I's are dotted and the T's are crossed, and there's not going to be any bad surprises later, because we're looking at everything together.
So you have those protections in place.
Exactly.
Well, and it sounds like, having your, getting your pre-approval, knowing what you can afford, starting to really look and see what's available in that price range so that when that house comes up that you do fall in love with, you feel confident that you can put that offer in right away and that you can be competitive with the other folks making an offer. And they're, if you're paying a little higher interest rate, then you might, if you're maybe waiting for interest rates to drop, but maybe you're not making a higher purchase price because you don't have the bidding wars and the competition trying to drive up the price. So, might be a trade-off.
Exactly. I mean, it really is. I had a fun cartoon for a while that someone had made about just how when the interest rates drop, everyone is making offers and it's just really, really crowded, and it's not as competitive right now. So it's easier to get your offer accepted. I'm also seeing a lot of off-market properties go into escrow. I have somebody in escrow right now on something that never hit the market. It was just one agent told the other agent. I mean, once you start working with someone, sometimes things will pop up that you didn't even have to compete on just because you found out about it first. So, I mean, there's always possibilities. And it's really helpful. And I think people forget when you find that house, what I see is a lot of people get very emotional and they get very excited. And so it's really good to have all the thinking work done, and planning work done so that when you are excited, you're ready to act.
Right. Well, let's go to the questions from our attendees and see if we can get those answered. Kim, what are you seeing in the Q&A?
Yes. So I think we answered the first one on how to choose a loan officer. I think we did cover that. The next question would be, what do you need to know about buying a mobile home, and what lenders can I go to?
Kathy, do you want to take that?
Sure. Okay, so when it comes to mobile home or manufactured home, we need a little bit more information. For example, a mobile home is something that is movable. It's more like a car loan, an installment loan, where a manufactured, if it's on a permanent foundation, then it can be treated as real property, meaning that most lenders can finance those properties that they're on a permanent foundation. But if your question is specific to a mobile home, there's few lenders out there. There's not going to be as many lenders that will do mobile home financing. For example, my company does not, but maybe Susan's company does. I don't know. But you do have to it's a different set of guidelines. You know, down payment assistance programs probably will not apply to mobile homes. And you have to be approved by the park. It's a whole different process for mobile homes.
Susan, does your company do mobile home loans?
Very limited. You have to own the land, and there aren't a lot of parks where you own the land. So, I have referrals for people that want to specifically purchase a mobile home. I agree with Kathy there. It's limited, and the rules are completely different with credit, with everything.
Mhm. We have, in terms of the network partners that work with Coastal Housing Partnership, the ones that do mobile home loans are Community West Bank, Montecito Bank and Trust, and P&B Associates. They're in Santa Maria. So those are the ones that we know about that do mobile home loans that offer a Coastal Housing Partnership savings.
Yeah, feel free to email us and we can send you that list and the lenders that facilitate those loans. So good question. The next question here is, some credit card companies have credit usages and reports in their personal bank account. Is that a good gauge? Is that a good gauge of someone's credit score?
Susan, you want to take that one?
Yeah, that is something that surprises people a lot. Is they will run their credit and they'll say, "Wow, when I ran my credit at home, it was totally different." And that's a very common thing that I hear, because the mortgage rating is different than the personal credit rating, and it's also different from the car rating. A car rating goes to a much higher number than mortgage rating. So, and I'm not exactly sure on how they do the consumer credit rating, but I know that a lot of people find that their rating for mortgage is not the same as when they run it through their bank. So it's not a dependable number. What could be dependable, though, is to look at the actual report. If they show you not just the number, but the history, to see if you have any late payments or anything like that, that information about what's been reported could be very useful. And but the actual numbers unlikely to be going to be the same. And a lot of people are worried about it, but often their score is fine. It's just a different scale than the consumer.
Another good reason to go see a lender now. Find out what that mortgage loan credit score is. Kim, you're muted.
This next question is again about a manufactured home. Can they get first-time buyer help or 3% down?
I think they would need to contact one of those three lenders, yeah, and reach out to us, and we'd be happy to send you that contact information.
Yeah, for sure. The next question is, if the last title I was on sold in October of 2021, is it worth waiting to buy again until October to qualify for the first-time buyer benefit?
Kathy, do you want to take that?
Sure. It's always a good time to plan ahead. So, you know, if you're sure that you need the down payment assistance programs, and there may be one or two programs that don't require the 3-year requirement. Maybe they just require that you don't own a property right now. So it is a good idea to speak to a lender in advance, and that way, and if you have to wait, then, you know, we will wait. Loan officers will not, or a lender, a good lender is not gonna be pushy, or would not be pushy. You know, when the time is right for you, then that's when we can update your file, if it's been more than 3 months.
But it seems like it's a good idea to see the lender and see, is this worth waiting? Because you don't want to
Yes.
put this on hold and then find out, oh, I didn't need to wait. There was a loan program that would have been just as good for me, and I could have gotten in the market a year earlier. So
Yes.
again, seeing a lender and getting that specifically done. It's when people self-eliminate on, you know, a number of different factors, it's unfortunate because I think that they really want to make that decision in terms of readiness based on conversations with a lender and knowledge from a lender.
Barbie, that reminds me that we did not touch on, in terms of waiting periods, we did not touch on bankruptcies or
Oh.
foreclosures.
Do you want to hit that, Susan? That'd be
Yeah,
helpful.
there are certain credit events that do have a waiting period. And often people are guessing incorrectly that it's 7 years or it's 10 years. And some of them are 2 years, some of them are 4 years. They do change depending on the loan type of loan program that you are going to be applying for. So if you've had a credit event in the past, like a foreclosure or a bankruptcy, and there's different types of bankruptcies, they have different types of waiting periods.
Mhm.
So that again would be something you really want to figure out exactly what the time frame is and the dates.
Yes.
Good.
And
I'm
may
glad you
I
brought
add-
that up.
May
Yes.
I
go ahead.
add too, when it comes to bank short sales, foreclosures, bankruptcy, it's not necessarily the day you think you sold the property. It's the date that actually the bank released the property off your name. So
Mm.
again, another reason to speak to a lender, because we can pull up all that information.
Good. Good tips.
Okay, the next question is, how do you suggest the cash under the mattress problem? Would you put it in the bank little by little, or how would you handle that?
That in terms of putting it in the bank little by little, I think that would be a really good thing to check with a CPA in terms of the tax consequences there. I know that the Bank Secrecy Act they look at large deposits. Ever since 9/11, they've had the Bank Secrecy Act, and there's a lot of concern over where money's coming from because they found out that money was being laundered to get weapons into the country. So I don't really know in terms of, like, from our perspective. I could tell you from a lender's perspective, once that money's been in the bank 2 months, it's considered yours. Whenever they see a deposit, they're going to ask, where did that money come from? And you're going to have to verify where that money came from in order to use the money. So it's tricky if it's in cash. There are things that can be done. Sometimes we've had people, it's complicated. I think that might be a offline question, but there's ways to not have to wait 2 months, but it's a little complicated. And in terms of the tax consequences or that kind of thing, I would defer to a CPA, but I could tell you how to make it work. And I'm sure Kathy could as well from a lending standpoint, and so that you didn't have to wait 2 months.
Great. Thank you.
Mhm.
If this person lives in California but wants to buy out of state, does the lending process change?
Kathy, do you want to take that?
Sure. Well, some lenders are also licensed in other states, or some companies can lend in other states as well. So it is possible that, maybe I can pre-approve you, but we have offices throughout the United States, so I could just transfer you to the office closest to where you want to live. The guidelines are guidelines, Fannie Mae, Freddie Mac, the conventional products. What may be different is your down payment assistance programs, should you be wanting those, because different states have different programs, or different counties have different programs as well. So you may want to, and two, if you're moving out of state, are you already employed over there? Because you have to establish owner occupancy of that property. So if you're moving out of state without a job, how are you going to verify your income? So all these things also can be determined with a simple conversation with the lender. So you can
Right.
plan ahead.
Great. And this last question I see is that this person's company provides a retirement savings account that allows them to take out loans for a home purchase or down payment. Do you know if this would impact their credit score for someone purchasing a home?
Susan, would you take that?
That will not impact your credit score. It does not get reported on there. And another really nice thing about it is I can't even think of one loan program that counts that payment back of your borrowing from your retirement against your debt to income ratio. And that's basically your income to your expenses. So it's a fantastic way to supplement your down payment. And it really doesn't have any downtime that I can see.
Great. Kim, any more questions, or is that it? Okay, well, if you have questions, both Kathy and Susan's contact information is here on the screen. You're welcome to contact them with any questions you have, or contact Kim or me. And we're delighted to support you in any way we can. And thank you so much for joining us today, attendees. And thank you to Kathy and Susan. Wealth of knowledge, wealth of information. Really appreciate you being with us. And we wish you success on your path to home ownership. Thanks for joining us.
Thanks for the invite.
Thank you.
Bye-bye.